What's up, guys? This is Manoj Papani. I welcome you all on behalf of the ATPDA world. So, guys, it's a beautiful day outside, and certainly you guys must be enjoying your day. I do hope that you are honoring your word of regular and recurring revisions that you promised to me at the very initial phase of our relationship. Perfect, guys. So, guys, by now we have already covered 5 presentations relating to the topic of equity analysis and valuation, wherein I made you understand about the various aspects relating to equity analysis by talking about fundamental analysis, technical analysis, charts, moving averages, and various other parameters. So, this is the 6th presentation in which I'll be talking about equity analysis, and this one is the last presentation in which I'll be talking about equity analysis. From the next presentation onwards, we'll start understanding the impact, nuances, and implications of equity valuation. So, this is probably going to be the last presentation on which we'll be solely dedicating towards equity analysis. Herein, I'll be discussing with you about the last remaining topics which are equally important as far as this particular topic is concerned. So, perfect, guys. Are we all set? Perfect. Let's take off with our first slide. Bollinger Bands. Remember, guys, I had a discussion with you regarding one of these tools with which you can analyze the price movements as far as these are concerned with the securities market. So yes, now it's the time to tell you something about Bollinger Bands. So what does basically a Bollinger Band mean? Let's understand that first. So Bollinger Bands are the technical trading tool created by John Bollinger in the early 1980s. The purpose of Bollinger Band is to provide a relative definition of high and low. So guys, basically these Bollinger Bands, they arose from the need for adaptive trading bands and the observation that volatility was dynamic and not static, as was widely believed at that moment of time. So the purpose of Bollinger Bands is basically to provide a relative definition of high and low. By definition, I mean that prices are high at upper band and low at lower band. This definition can aid in rigorous pattern recognition and is useful in comparing the price action to action of indicators to arrive at a systematic trading decisions. So with the help of Bollinger Band, you can actually strive out for the perfect kind of equilibrium wherein you can get the kind of best benefit of the prices, wherein you'll be able to decide at which price you want to trade in or at which price you want to exit the market with the help of that. So prices are high in upper band and prices are low at lower band. So this basically helps in rigorous pattern of the recognition and certainly is useful in comparing the price action to the action of indicators to arrive at a systematic trading decision. So guys, a stock may trade for a long period of time in a trend, albeit from time to time with some certain kind of volatility. To better see the trend, traders use moving averages, which I just had a discussion with you in my last presentation. And they use basically moving averages to filter the price action. This way, traders can get and gather important kind of information regarding how the market is trading. For example, after a sharp rise or fall in a particular trend, the market may consolidate, trading in a narrow fashion, and this will crisscross above and below the moving average. To better monitor this kind of behavior, traders use price channels, which are designed to encompass the trading activity around the trend. Bollinger Band is a form of price channel tool which is used by traders, and that's how it is being used primarily with a lot more kind of traders, those who are basically established in India or in any other part of the world. Bollinger Bands are usually one of the most popular tool to understand the nuances and complications which are involved in pricing behavior of the securities. So Bollinger Band is basically a form of the price channel tool which is used by the traders. Now you guys must be thinking about how does this Bollinger Band actually looks like. I know, guys, the kind of excitement that you have in order to understand the basic nuances of this financial world. So I won't keep you in much of a delay. Let's headshot to image. So this is basically how a Bollinger Band usually looks. So this is a currency based Bollinger Band wherein euro is being termed with in comparison with the United States dollar. So euro is in comparison with dollar over here, and we can simply see this one thing, that euro 1 euro is basically equivalent to $1.30768. So if you are going to purchase 1 euro, so you'll have to shed almost 1.30768 bucks in order to get that. So this is basically the center line. If you can just see over here, this is the center line. Okay, so a Bollinger Band usually consists of a center line and two price channels, one above it, which is this one is above, and this one is lower complete area. Okay guys, so two price channels are there over there, one above the center line, one below, and this particular center line is a kind of exponential moving average. Remember, we just had a discussion about moving average, exponential moving average in my last presentation, and these price channels are the standard deviation of the stocks, which is basically this chart list in which we are studying. So these price channels, these lower one and these upper one, so these are basically used for the trending purposes. These bands, usually the bands will expand and contract as the price action of a particular issue will become volatile. Volatile, by volatile I'll mean like expansion, and it will become bound into a tight trading pattern, which is contraction. So that will happen depending upon the demand and supply factors. So whenever you are like using Bollinger Bands, we designate upper and the lower band as a target. So herein my target would be, okay, if it is moving by like this particular tip, okay, so if I'll be like purchasing my price at this moment, okay, my kind of target should be that I need to sell it off by this moment. Okay, that's because after this the prices are going to decline again. So this is my kind of upper band, the highest upper band which is available. And if I want to like purchase the security at a lower prices, I'll have to wait for it to go down again by this moment. This has already happened. So we actually don't have anything to do with these. So if we are considering upon concentrating on these parameters, you'll have to wait till this time struck, and wherein I'll be able to invest my money into these securities. So this basically currency. So therein I'll be able to extract the best kind of benefit, taking upon the advantage of demand and supply factor using the Bollinger Bands. So these are basically termed as a price targets. And if like let's suppose the price deflects off the lower band and crosses above like a 20-day average, which is the kind of middle line which is available. Okay, so the upper band comes to represent the upper price target. In a strong uptrend, prices usually fluctuate between upper band and a 20-day moving average. That's happen on a general basis. And what happens is a crossing that is below the 20-day moving average warns of a trend reversal to the downside. So if something happens and the stock is moving below 20-day moving average, then it's a time to take precautions. Otherwise, the stock or currency, whatever in which you are dealing in, is going to fall down, and that is going to impact your liquidity and your profitability as well. So these Bollinger Bands usually help you in deciding about the upper bands and the lower bands. By upper band will usually help you in deciding that by this particular situation or juncture, you'll be able to like completion of your selling of the security. You'll have to do it by then. That will be the upper band. And by if the prices are touching like lower band, that's the right time to buy the security or buy that currency, because it has reached its utmost bottom. So beyond that, it won't go any further. So these is basically the help which people get from Bollinger Bands, and this is how it looks. Let's understand another example, which will be again for GBP in terms of Japan yen currency. So in 1 GBP you have like almost these 142 yen, 141, 141, 140 yen. So this is how it is being traded. Okay, so if I'll be talking about the same aspect with center line and the price trends. So here is this center line. Okay, if you can see guys, this is the center line. Above this, it's the upward price trend. Okay, this is going to be the higher one. This is the price trend which is moving towards high. And this is the moving trend which is moving towards low price band. Okay, so this is the particular center line. So here's the highest peak of it, which is this is the highest upper band, and this one is the lowest band. So basically prices usually allow you to understand the nuances and implications by telling you that this is the maximum price with which the currency is going to go, and this is the lowest price beyond which the currency won't fall any further. So with the help of these Bollinger Bands, you can adjust your trading accordingly. Whether you are trading in a particular security or you are trading in a particular currency, you can adjust your amounts using or understanding or considering these kind of center line and price trends, wherein the upper will be provided and the lower one. So that's how it's a wonderful tool. If you can actually extract the best kind of benefit using this tool, that will help you and earn riches, guys. So you'll have to understand this particular segment, and I hope I was able to review this particular segment with a complete clarity, and I'm sure you'll be able to perform it very well if in case questions comes into the examination, though it will come only for the sake of like 4 marks. But I am making my prerogative here is to provide you the financial literacy as far as this financial world is concerned. So my prerogative is not just for the examination point of view, but to provide you the overall kind of knowledge as far as the stock markets are concerned. So that was all about Bollinger Bands. Now let's move to our next topic relating to random walk theory. So guys, let's understand what does random walk theory means. So what do you understand by the term random? Random means moving anywhere around, right? You don't have a designated path on which you want to move. You don't have a designated destination where you want to head to. Perfect. So you'll be like moving anywhere. That's random. Correct. And what does walk means? Walk simply means walking anywhere. So what does random walk mean? Random walk means moving from one place to another wherein you don't have any designation fixed and where you don't know where you are actually heading to. So that's kind of random walk which people usually do from one place to another. Okay. So this is the basic thing behind random walk. So if I'll ask you to associate this random walk principle with the price movements, what you will understand? I'm sure you are getting it absolutely right, guys. So random walk basically means, as far as the prices of the securities are concerned, random walk theory states that prices have no kind of interrelation with the technical analysis or something else. So prices move randomly in stock market, and you can't get the best kind of benefit using your technical analysis, fundamental analysis, by evaluating whether to invest in a stock or not. So this is what random walk theory says. So basically, if I have to sum it up in one single way, I can simply tell you that random walk theory is basically against the usage or importance of technical analysis, fundamental analysis. Random walk simply tells you that it is impossible to outperform the market on a consistent basis. The supporters of this theory basically say that both technical analysis and fundamental analysis are largely a waste of time. So they take it like that. So that's what random walk theory basically means. Now that was about the basic part of love. Let's understand it by digging it a bit further so that you can get the complete understanding and clarity as to what this theory means. So random walk theory basically asserts that it is impossible to outperform the market on a consistent basis. The supporters of RWT, random walk theory, says both technical analysis and fundamental analysis are largely a waste of time. The basic random walk premise is that price movements are totally random and you can't outperform the market on a consistent basis. So that's what it tells you. In fact, they actually say, these people, the supporters of this random walk theory, they say that there is actually no proof to suggest that either can consistently outperform the market. So actually ask for no kind of proof because they know it, because that can't be outperformed at all. So the prices movements is absolutely random as far as this theory is concerned. And judging from any kind of chart, like line chart, bar chart, candlestick chart, the price movements of any company over a 5-month period would appear to be quite random as to what they say. Okay. As per this theory, price has no memory, and therefore past and present prices cannot be used to predict the future prices. This is what they say. So movements depict the way a drunk man walks on the street. So as per this theory, prices have no memory, and therefore past and the present prices cannot be used to predict the future prices. Prices move at random and adjust to a new information as it comes available. Okay. The adjustment to this new information is so fast that it's impossible to profit out further from it. And furthermore, news and events are also random, trying to predict these kind of fundamental analysis, which just a kind of lesson for futility. Again, so this is what basically this random walk theory means. And supporters of random walk theory basically maintains that a price simply a buy and a hold strategy is the best one. An individual should not attempt to time, outperform or beat the market. So I won't deny with the fact that random walk theory is absolutely absurd. No, that does mean some logic, right, guys? So it's not that you won't get the benefit out of fundamental analysis, technical analysis at all. It's not just like that. It's not as simple as that. But on one particular point of time, when I'll agree with this random walk theory, would be that a buy and a hold strategy is absolutely the best. Okay, guys. So the people who are trying to outperform the market day in day out on intraday basis, they are actually not able to extract the best kind of benefits, because if you are like opening your bid in the morning that I want to purchase the security on so price, and by the end of the day I'll be like selling it. So there are chances that prices won't go up in such manner, and certainly you will have to bear a loss, right? So it's always better and recommended, if you are a perfect kind of technical analysis or a perfect kind of fundamental analyst. So it's always recommended that always go for a kind of security in which you truly believe in the kind of business that they are doing. That might be into aviation, that might be into banking business, that might be into FMCG. But always go for a kind of particular security wherein you have utmost satisfaction with the kind of business that they are doing. Okay, you know that their business is genuine, and certainly that is going to grow in future concerns. So no kind of going concern problem is available with that kind of business. So it's always recommended to invest in that kind of business wherein you understand the nuances of it. Okay, and hence it is always recommended to go for a simply buy and hold strategy. I've seen people who have like invested in penny stocks. I would actually say penny stock or very small stocks, wherein this kind of benefit of understanding the business first, they acquired so many shares under the price of 50, and today those prices have gone for like almost 300, 400 and 500. Think about the kind of money they made using that kind of technique. Had it been the case, they would have gone for a simply intraday option, wherein they would have like started purchasing the securities once and would have been like selling it maybe on the same day using intraday, or maybe by like week or month or maybe 6 months. So that would have the kind of return that they made wouldn't have been possible had it been they would have gone for this kind of situation. So it's always recommended to go for buy and hold strategy on those kind of securities where you do understand the business very well and you accept the fact that certainly this share is going to go for an upper side because you understand that business very well. Okay, so on this front I basically agree with the random walk theory. Apart from this, I won't consider this theory as the best one because it goes against any kind of fundamental analysis or technical analysis, which shouldn't be there. It's a learning stage, guys, and you must go for the kind of learning which is being concerned with the fundamental analysis and technical analysis. That way you'll be able to grow up your mindset as far as this financial world is concerned. So this was all about random walk theory. I guess you got the complete clearance of how it works out. So let's move to our next theory, and that will be Dow theory. So what is this Dow? So guys, you must have understand and knew something about Dow Jones, right? That's one of the major thing which is happening abroad as far as the US market is concerned. Nasdaq, Dow Jones, these kind of things usually come to your way. Okay, as far as the foreign stock exchanges and things are concerned. So basically this Dow theory, this Dow theory was developed by Charles Dow way back, and which was refined by William Hamilton. The same was articulated by Robert Rea and is basically addresses not only on the technical analysis and price action and also price market philosophy. So that's how this theory basically goes on. So let's understand how this theory works. This theory basically tells about, first of all, about the market movements. So guys, Dow and Hamilton, these are the two persons who identified three types of price movements for Dow Jones Industrial and Trail averages. So way back, it used to be called like this. So basically three price movements. One is primary movement, second is secondary movement, and third is the daily fluctuation. Okay. So what does this primary movement means? What does this secondary movement means? And what does this daily fluctuation mean? Let's understand them one by one in order to get the complete clarity. So primary movements, first of all. Primary movements are the ones which represent the broad underlying trend of the market and can last from a few months to many years. Okay, so these are the primary movements as far as this are concerned. Okay, these movements are typically referred to as the bull and the bear markets. Once the primary trend has been identified, it will remain in effect until proven otherwise. Success, according to Hamilton and Dow, is basically measured by the ability to identify the primary trend and staying with it. That's what I'm telling you guys, buy and the whole strategy. So that's what it goes with primary movements. Okay, you understand the basic nuances of a particular business, you start investing in it, and you go for the investment for like many years. Okay, it could be like you are increasing your stake in the company, or you have like already entered into it, though you are not increasing your stake in the company. However, having said that, you are also not exiting the market while selling off your securities with that kind of company. Okay, so this is basically concerned with the primary movements. So now let's move to secondary one. Okay, so simply secondary movements, in case of primary movements, that they last from a few months to many years. In case of secondary movements, they last from few weeks to few months and move counter to primary trend. So that's how they work in such cases. Okay, counter trend and primary kind of need. So secondary movements usually run counter to the primary trend and are reactionary in nature. In bull market, a secondary move is considered a correction. In the bear market, secondary moves are sometimes called as a reaction rallies. These are the technical terms. Hamilton basically categorized secondary moves as a necessary kind of phenomenon to combat its excessive speculation. Corrections and counter moves kept speculators in check and added a healthy dose of guesswork to the market movements. Because of their complexity and deceptive nature, secondary movements requires extra careful study and analysis. Investors often mistake a secondary move for the beginning of the new primary trend. So that's how it creates some kind of complications, because it's complex in nature, and that requires a deep, thorough understanding of the markets first. That was all about secondary markets. Then comes daily fluctuations. So guys, in case of daily fluctuation are the ones which can move with or against the primary trend and last from a few hours to a few days, but usually not more than a week. Okay, so daily fluctuation is the one which has the shortest span of time as far as the investment is concerned. Secondary movement is basically having the more time span as far as this daily fluctuation is concerned, but that is having lower time span as far as this primary movement is concerned. But in case of primary movements, that's having the largest span of time as far as the securities investment is considered. So that's the basic three differences between these three. So daily fluctuation, while it's important when viewed as a group, it can be dangerous and certainly unreliable individually. Due to the randomness on the movements from day to day, the forecasting value of the daily valuations and fluctuation is limited at its best. So at worst, too much emphasis on daily fluctuation will lead to forecasting errors and possible losses. The study of daily price action can add valuable insight, but only when taken in context with the larger picture. There is a little structure in 1, 2, or 3 days worth of price action. However, when a series of days is combined, a structure will start to emerge and analysis will become better grounded. So, it's always recommended to go for a simple longer period of duration. Why? Because daily fluctuation usually might create a possibility of incurring huge losses. Supposedly, one share is going up from 3 days, and if you'll be like analyzing just the 3 days trend, what you'll do? You'll simply go and ask your broker, okay, purchase it for me. Simple, because you are analyzing and understanding the business in that way that surely if it has like gone up for the last 3 days, definitely it will go for the fourth day as well. You'll simply have that kind of understanding, right, guys? But what if after 3 days simply that stock go down badly? So what's going to happen? You already purchased that security on the fourth day. By the end of that day, you are going to incur huge losses, right? Why? Because you just emphasized on the 3 days data that was too short to be analyzed as far as the overall understanding of that particular business or security is concerned. So while analyzing any kind of price movements, always go for a larger kind of picture wherein you'll be able to know that how this trade in security fared. Did it fare well all during the last 1 year, 6 months, or maybe 2 years? That way you'll be able to understand whether the business is growing steadily or it's declining or growing a kind of similar fluctuations altogether in the overall market. So this is the basic drawback with daily fluctuation. Okay guys, so that was all about the three kind of price movements: the primary movements, secondary movements, and daily fluctuations. This was all about the Dow theory. Now you'll be like having a thought whether it should be called as a theory, right? Perfect guys. So this is the kind of basic problem as far as the situation is concerned, because many of the people actually don't consider it as a theory. So let's understand what are the criticisms of Dow theory. So the first one, the first basic and the primary criticism for any Dow theory is that it is really not a theory. So it basically tells you about the price movements as far as these are concerned with the primary market, secondary market, or daily fluctuation. However, we can't term it as a proper theory. It doesn't provide you any kind of theoretical theory on which you can easily emphasize on. So neither Dow nor Hamilton basically wrote any kind of proper academic papers outlining the theory and the testing of theorems. So the ideas of Dow and Hamilton were put forth through their editorials in the Wall Street Journal. And Robert Rea, that's the person who stitched this theory together by poring over his writings. So that's how it went on. So it was never a theory initially. It became a theory only after so many people have put in their efforts into it. So that was the first criticism for it. The next one, the Dow theory is basically criticized for being too late. So guys, the trend does not change from bearish to bullish until the previous reaction high has already been surpassed. And that's the only problem. Many of the traders usually feel that this is simply too late and misses much of the move. By the time they apply this kind of Dow theory, the time has already gone by, and they don't actually get the benefit of extracting out the best kind of returns while emphasizing on this Dow theory. So that's the second con for it. The Dow theory is basically criticized for being too late. And the third one, the last one. So the Dow theory is criticized as being outdated and no longer can provide an accurate reflection of the economy. So that's another kind of problem which people think about it. So people usually criticize Dow theory of being outdated in the market, and they simply have this kind of perception that it cannot be implemented now effectively in any manner. That was way back when periods used to be in the kind of previous times when Dow and Hamilton used to perform over there. But nowadays, in this present scenarios, this particular theory doesn't provide you any kind of accurate reflection of the economy. So these are the basic three criticisms which are being involved in Dow theory. One is it is actually not a theory. Second, it's criticized for being too late. And the third one, it's actually criticized for being outdated and no longer providing the actual reflection of the economy. So guys, that was all about the Dow theory. I guess you got the complete understanding as to how this theory works and what are the related criticisms with this. Now let's move to our last topic of the day, and that will be our last theory, which will be market breadth theory. Guys, have you ever thought about something like probability? Okay, absolutely yes. Each one of us done probability once or for all. So if you have like 2 options, 3 options, 4 options, 8 options. Okay. So market breadth theory basically talks about what's the possibility of more advances or what's the possibility of more declines as far as the overall security market is concerned. So basically, market breadth theory, as the word says, what's the market's breadth in terms of expansion is available. So if, like, let's suppose today I have, on a simple basis example, if I'll say I have only 100 stocks in the market, okay, 100 companies are trading its securities, and out of that 70 companies share prices are going up, they are advancing, okay, and 30% of the shares of the companies are going down. So what I'll simply say with this belief, what I'll say, that the market is going up. Absolutely, guys. So if I'll have to conclude it with Nifty or Sensex, I'll say if Nifty is going up, so most of the companies are going up. If Nifty is going down, because that's a benchmark, so most of the companies are going down. So basically, a market breadth theory is a technical analysis theory that predicts the strength of the market according to the number of stocks that advance or decline on a particular trading day. So that's the basic definition of market breadth theory. So with this example, I'll be like able to help you up in understanding it better manner. So that's why I included it my skill. So that's a technical analysis theory that predicts the strength of the market according to the number of stocks that advance or decline in a particular trading day. So the breadth of the market indicator is used to gauge the number of stocks which are advancing or declining on a particular day. If breadth indicator is strong, this theory predicts that the market will be rising. And if the breadth indicator is weak, this theory predicts that the market will be declining. Advanced or declining index, if I'll have to compute it in a way, what's the formula for that? So that will be advances minus declines plus advance or decline index value of the previous period. That's how advance or decline index for the present day can be calculated. So now you will be thinking about, sir, what does this advance or decline index basically means? So a market breadth index is an advance or decline index basically, which is depicting the total number of advancing and declining security prices in a stock market. This formula basically you will be able to evaluate the value in real time basis, and this is particularly one of the most widely used market breadth indicators formula with the help of this index. Okay, so this advance or declining index is basically used to measure the breadth of the market by long-term investors. This index is actually not a timing indicator in itself, but can be used with other key market signals to gauge when the market isn't losing steam. The advance and declining index is used to measure the breadth of the market by long-term investors. The index is actually not a timing indicator by itself, but can be used by other key market signals to gauge when the market isn't losing steam. And when the value of the formula is actually printed on the price chart, it is simply known as advance or decline line. So guys, that was all about the theories relating to random walk, Dow theory and market breadth theory. I guess I was able to perfectly emphasize on the understanding of the same, and definitely I was able to deliver it in a proper manner, and you guys must have liked it as well. So perfect guys, with this I'll be concluding my video with a dose of motivation, and that will be: learn from the past, set vivid, detailed goals for the future, and live in the only moment of time over which you have any control, and which is now. Now is the time. Guys, this quote was being mentioned by Dennis Waitley. So you have to learn from all the past. You have to set extremely great kind of goals for yourself, the one which are detailed in nature for a future. And the only thing which you'll have to focus is on, that is now. You don't have anything to do with your past that has already happened. You don't have anything to do with your future that will be happening. So the only thing which you are having in your hand is the control for now. So do it perfectly. Do it in a best manner, best shot you can. Perfect guys, with this, I'll say a thank you on behalf of the Edupedia world. Keep interacting guys via questions, queries and comment boxes of YouTube. Stay connected, that will help us in understanding your needs way better, and that will help us in making a clear and a great bond with you. Perfect guys, love you all, take care, bye.